The Federal Reserve. The name itself evokes a sense of power and mystery, a behind-the-scenes force shaping our economic landscape. But what exactly does this institution do, and how does it influence your everyday life? Today, we're peeling back the curtain on the Fed and exploring the intricate systems that help keep our economy on track. At the heart of understanding our economy's health is the Consumer Price Index, or CPI. Think of it as a massive, ongoing survey of what households are actually buying. It tracks the prices of a representative basket of goods and services, everything from groceries and gas to rent and haircuts. By monitoring the changes in this basket's price over time, we get a clear picture of inflation, or the rate at which prices are rising. But how do we actually build the CPI? It's a complex process. Imagine statisticians meticulously collecting prices from thousands of stores for tens of thousands of items month after month. These prices are then averaged, but not just any average, it's a weighted average. This weighting is crucial. It reflects how much consumers actually spend on each category. So if people spend a significant portion of their income on housing, changes in housing prices will have a larger impact on the CPI than, say, changes in the price of a specific type of candy. This weighting system is where things get really interesting. The CPI doesn't just use simple percentages, it employs intricate sub-indices and sub-sub-indices. These are combined using weights that reflect their share in total consumer expenditures. Think of it like building a complex recipe. You need the right proportions of each ingredient, or in this case, each good and service, to get the final, accurate measure. Estimating these weights involves sifting through household expenditure surveys and national accounts, a task that requires careful adjustments and constant refinement to reflect changing consumer habits. One of the most debated aspects of CPI calculation involves owner-occupied dwellings. Economists wrestle with how to price the service of living in a home you own. Should it be based on what you could rent it for, or the opportunity cost of selling it and earning interest on that capital? Each approach has its complexities, from volatile house prices affecting the index to the difficulty of estimating rental values for non-rented properties. It's a fascinating look at how economic theory meets practical measurement. In the United States, the Bureau of Labor Statistics, or BLS, is the key player, calculating various CPI measures like CPI-U for all urban consumers and CPI-W for urban wage earners. These indices differ in their weighting, reflecting different spending patterns. For example, Social Security recipients get a cost of living adjustment based on CPI-W, but critics argue this doesn't fully account for the elderly's higher spending on healthcare, where prices have risen faster than the general inflation rate. They also track a CPI-E specifically for the elderly, though it's not currently used for adjustments. Then there's the chained CPI. Unlike the standard CPI, which uses expenditure weights held constant for a period, the chained CPI updates these weights monthly to reflect recent changes in consumer spending. This means it can more quickly capture shifts like people buying more chicken and less beef. Proponents argue it's a more accurate measure, potentially saving the government billions by offering a more modest cost of living adjustment. However, concerns remain about its ability to fully account for seniors' healthcare costs. Beyond the CPI, the U.S. also uses the Personal Consumption Expenditures, or PCE, price index. The Federal Reserve often favors the PCE-PI, partly because it uses a more dynamic weighting system that accounts for consumer substitution effects essentially. If the price of one good rises, consumers might switch to a cheaper alternative. While the CPI measures out-of-pocket expenses, the PCE-PI captures spending more broadly. From 1959 to 2018, the PCE-PI generally showed lower inflation than the CPI, a difference that matters significantly for economic analysis and policy. The Federal Reserve System itself is a unique entity, an independent central bank within the U.S. government. Its structure is a deliberate hybrid. A publicly appointed board of governors oversees 12 regional Federal Reserve banks, which in turn regulate privately owned commercial banks. This public-private balance was struck to balance public control with the practical needs and expertise of the banking industry, a compromise forged through a history of financial panics. The Fed operates under a dual mandate set by Congress to promote maximum employment and stable prices. Stable prices are generally interpreted as keeping inflation around 2% per year on average. These two goals can sometimes be in tension. Policies that boost employment might also increase inflation. The Fed constantly analyzes economic data, from unemployment rates to inflation figures, to strike this delicate balance and steer the economy toward its objectives. How does the Fed actually steer the economy? It uses a range of powerful tools. Beyond directly adjusting interest rates, they engage in open market operations, buying and selling government securities to influence the money supply. They also have tools like the term deposit facility and can even implement quantitative easing by purchasing assets to inject liquidity into the financial system. These aren't just abstract economic concepts, they are levers the Fed pulls to manage everything from lending to investment. Interest rates are truly the pulse of the economy. They influence how much it costs to borrow money for a car, a house, or a business expansion. When interest rates are low, borrowing is cheaper, encouraging spending and investment, which can boost employment. Conversely, when rates are high, borrowing becomes more expensive, which can cool down an overheating economy and curb inflation. The Fed's target for the federal funds rate, the rate at which banks lend reserves to each other overnight, ripples through the entire financial system, influencing everything from your credit card APR to long-term bond yields. The concept of interest rates can get even more complex, venturing into negative territory. While it sounds counterintuitive, some central banks have experimented with negative interest rates on reserves held by commercial banks. The theory is that by charging banks to hold reserves, the central bank encourages them to lend that money out instead, stimulating the economy. While rare, this tool highlights the unconventional measures central banks might consider when facing persistent deflationary pressures or economic stagnation. The history of monetary policy is a fascinating journey, from ancient debasement of coinage to the gold standard, and eventually to today's inflation-targeting frameworks. Central banking has continuously evolved. We've seen attempts to control economies by managing money supply, a strategy that proved difficult due to unstable relationships between money and economic activity. Today, transparency and communication, like forward guidance, are increasingly vital tools, aiming to shape public expectations and guide economic behavior. And how do tariffs fit into this complex picture? Recent data shows inflation ticking up, with some economists suggesting companies are starting to pass on the costs of tariffs to consumers. Goods like furniture and apparel, which are often imported, saw price increases, while new car prices unexpectedly dropped, possibly due to consumers buying before tariffs hit. The overall trend is being watched closely. Economists debate the extent and timing of tariff impacts and how they might influence the Fed's decisions on interest rates. It's a dynamic interplay between trade policy and inflation, a key factor in the ongoing economic narrative.